What if everything you thought you knew about money was a carefully constructed illusion? We're taught to save. Your bank doesn't just hold your money, it creates it out of thin air every time it makes a loan. This isn't some fringe conspiracy. The real question is, who benefits when we misunderstand the very nature of money? Imagine a world where money isn't just paper in your wallet, but a living, breathing force flowing through an invisible network. You've probably felt its power. But what if you could see the strings? What if you understood the puppeteers behind the curtain? I'm going to pull back that velvet drape and show you the real engine room of our economy. We'll trace the journey of a single dollar from the Federal Reserve's printing press, through the arteries of commercial banks, all the way into your digital account. You'll discover why banks can lend money they don't technically have, how your mortgage is connected to someone else's retirement fund, and why the entire system relies on a delicate dance of trust and risk. This isn't just theory. It's the hidden architecture shaping your financial life every single day. By the end of our time together, you'll understand its secret language. Picture a world where money wasn't paper or coins, but something far more tangible. Ancient civilizations traded cattle. This was the bedrock of human exchange, a system built on immediate physical worth. How did we journey from that tangible reality to the abstract digital universe of finance we inhabit today? The story begins with gold. For centuries, this gleaming metal served as the ultimate store of value, universally desired and difficult to obtain. But carrying heavy gold for every transaction was impractical, even dangerous. A solution emerged. Goldsmiths began storing people's gold in secure vaults, issuing paper receipts that could be redeemed for the metal itself. These slips of paper were the primitive ancestors of our modern banknotes, a promise of value rather than value itself. A fundamental shift had occurred. Trust in a promise began to replace the comfort of physical possession. This system evolved into the gold standard, where a nation's currency was directly convertible into a fixed amount of gold. It created a stable, disciplined framework for international trade. Yet this golden anchor also had a critical flaw. It tethered a nation's economic potential to the finite amount of gold it possessed. Growth was constrained by the contents of a vault, not by the ingenuity of its people. Everything changed in 1971. Facing immense economic pressures, President Richard Nixon made a historic decision. He suspended the convertibility of the US dollar into gold. The world held its breath. This single act, known as the Nixon shock, severed the final link between global currencies and a physical commodity. Money was no longer a claim check for gold. It was now a pure social construct, a collective agreement of value, backed solely by the full faith and credit of the government that issued it. We had entered the age of fiat. Suddenly, the rules of the game were rewritten. Central banks, once limited by their gold reserves, now possessed a powerful new tool: the ability to create money from nothing. With the turn of a dial, they could influence the entire economy, controlling the supply of this newly abstract entity to fight inflation or stimulate growth. The very nature of money had transformed from a tangible asset into a sophisticated instrument of policy. This monumental shift created the complex, interconnected, and often bewildering financial ecosystem we navigate today. A system where digital entries in a ledger can represent immense wealth, where confidence can build empires, and where fear can evaporate trillions in an instant. Understanding this journey, it is the essential first step to comprehending the invisible architecture that governs our financial lives. An architecture built not on stone, but on belief. The fundamental conflict at the heart of modern finance isn't between bulls and bears, but between the system's stated purpose and its actual mechanics. We're told markets exist to allocate capital efficiently, yet what we've created is something far more complex and contradictory. How did we build a financial ecosystem where stability often depends on instability? Consider the very nature of money creation. Commercial banks don't simply lend out deposits, They create new money through the lending process itself. This isn't some conspiracy theory, it's the operational reality of fractional reserve banking. When you take out a mortgage, the bank isn't handing you someone else's savings. It's generating new digital money that previously didn't exist. This creates an inherent tension. The system requires perpetual debt expansion to keep the money supply growing, yet that very expansion creates fragility. Why does this matter? Because this debt-based money system creates what economists call the financial instability hypothesis. The more successful the system becomes at generating credit, the more vulnerable it becomes to sudden collapses. We're essentially building taller and taller financial structures on foundations that require constant reinforcement through new borrowing. It's a beautiful, terrifying paradox. Look at the 2008 financial crisis through this lens. The housing bubble wasn't an aberration. It was the system operating exactly as designed, just pushed to its logical extreme. Banks created mortgage debt, which became someone else's asset, which then got packaged into complex securities that themselves became collateral for more borrowing. The system was doing what it does best, manufacturing financial claims, until suddenly, it couldn't. This brings us to the central tension between real economic value and financial value. A factory produces goods, a farm grows food. But what does a collateralized debt obligation produce? It produces claims on future income streams, which then get traded, leveraged, and transformed into yet more financial instruments. We've built an entire universe of financial assets that dwarf the underlying real economy they're supposed to represent. The tail isn't just wagging the dog, the tail has developed its own ecosystem. Think about the psychological impact of this divergence. When financial markets become detached from economic fundamentals, they create what economist Hyman Minsky called euphoric economies. People start making decisions based on asset price movements rather than underlying value creation. Companies focus on financial engineering rather than product engineering. The system rewards speculation over production. Real talk, where it gets truly concerning. This isn't just about Wall Street versus Main Street. The conflict has seeped into every aspect of our financial lives. Your pension fund needs 7% annual returns to meet its obligations, forcing it into riskier assets. Your local government relies on rising property values for tax revenue, creating incentives to keep the bubble inflating. Even your personal financial planning assumes continuous market growth that may not align with economic reality. The most dangerous aspect? We've institutionalized this tension. Central banks now see their primary role as managing these financial cycles rather than preventing them. They've become the ultimate backstop for a system that naturally generates bubbles and crashes. This creates moral hazard on an epic scale. The knowledge that someone will clean up the mess encourages even riskier behavior. It's like having a fire department that doesn't prevent fires but stands ready with bigger hoses each time one breaks out. What happens when the financial economy becomes so large that it dictates terms to the real economy? We're seeing it already. Companies taking on debt not to invest in factories or research, but to buy back their own stock. Bright graduates flocking to finance rather than engineering or science. Housing becoming an investment vehicle first, and a place to live second. The means have become the ends. This systemic conflict creates what philosophers might call a category error. We're using financial metrics to solve problems that require different frameworks entirely. Climate change, inequality, infrastructure decay. These can't be solved by creating new financial derivatives, yet that's often the first tool we reach for. We've become so adept at financial innovation that we've forgotten how to do other kinds of innovation. The tension between what finance could be and what it has become represents one of the great unresolved conflicts of our time. A system designed to serve the economy now often commands it. Tools created to manage risk now generate new forms of risk. Mechanisms intended to create stability now produce instability. Understanding this fundamental contradiction isn't just academic, It's essential for anyone trying to navigate the modern financial landscape without becoming collateral damage in a system at war with itself. Have you ever wondered why the stock market sometimes feels like it's operating on a completely different planet from the real economy? We see headlines about strong employment data, yet the markets tumble. Or we hear whispers of a recession, and the S&P 500 hits a new all-time high. It's enough to make anyone's head spin. The crucial insight we need to grasp is that the market isn't a direct reflection of the present-day economy. It's a massive, collective prediction machine, constantly pricing in the future. It's not about what is happening, but what a critical mass of investors thinks will happen 6, 12, or even 18 months from now. Imagine a giant auction house, but instead of bidding on a painting that's hanging right in front of them, everyone is bidding on a detailed description of a masterpiece that's still being painted in a back room. They're making their bets based on the artist's reputation, the quality of the preliminary sketches, and rumors about the available paints. The final price is set not by the current state of the canvas, but by the consensus view of its future value. That's the market. Every single stock price, every bond yield, is just the current equilibrium of millions of these forward-looking bets. This explains the seeming madness. When bad economic news comes out and the market rallies, it's often because the news wasn't as bad as everyone had feared. The market had already priced in a catastrophe, so a mere disaster looks good by comparison. Conversely, when fantastic earnings reports lead to a sell-off, it can be because the results, while great, didn't exceed the sky-high expectations that were already baked into the share price. The market is a perpetual game of beat the expectation, not report good numbers. So how do we, as individual investors, navigate this? We must shift our focus from the noisy headlines of today and train ourselves to think in probabilities about tomorrow. Instead of asking, is the economy good right now? The more pertinent question is, what is the current market price implying about the future? And do I think that prediction is too optimistic or too pessimistic? This is the core of a contrarian mindset. You're not betting against the news, you're assessing the collective psychology embedded in the price. When euphoria is universal and priced for perfection, that's often the riskiest time to buy. When despair is absolute and assets are priced for annihilation, that's frequently when the greatest opportunities emerge. Think of the most successful investors in history. They weren't just number crunchers. They were master psychologists who understood this auction house dynamic. They possessed the patience to wait for the gap between the market's emotional price and their own calculated estimate of intrinsic value to widen to an extreme. Your edge doesn't come from having a faster news feed. It comes from having a more disciplined, long-term framework that allows you to see when the crowd has become unhinged by either greed or fear. The real money isn't made in the frantic buying and selling. It's made in the waiting, in the quiet confidence of holding an asset that the market has temporarily mispriced. That gap between price and value is the fundamental source of all investment returns. Imagine you're a young professional, just a few years into your career, with a modest savings account and a vague sense that you should be investing. You've heard about stocks. How does your small investment actually connect to the sprawling global economy? This is where understanding the plumbing of the market, the flow of capital, becomes not just academic, but financially empowering. Consider the journey of a single dollar invested in a low-cost S&P 500 index fund. That dollar doesn't just sit in a vault. It is transformed into capital. It flows through asset managers into primary markets via investment banks during initial public offerings, and ultimately becomes part of the equity financing that allows a company like a renewable energy startup to scale its operations. Your capital, pooled with millions of others, directly fuels innovation and economic growth. This isn't an abstraction. It's the circulatory system of modern capitalism, and you are a part of it. Big question. Shift perspective to a small business owner seeking a loan to expand. She approaches her local bank. Where does the bank get the money to lend? It doesn't simply lend out deposits. Through the process of fractional reserve banking and by accessing wholesale funding markets, often by issuing bonds or borrowing from other financial institutions, the bank effectively creates new money in the form of credit. Her successful loan application and subsequent expansion are a direct result of this credit creation mechanism, a core function of the financial system that most people never see. Her story is a testament to the system's generative power. But what happens when this system seizes up? The 2008 financial crisis offers a brutal, real-world case study. The problem wasn't just bad mortgages. It was a catastrophic failure in the chain of trust and the pricing of risk within the shadow banking system. Mortgages were bundled into complex securities, CDOs, which were then sold globally. When the underlying assumptions about housing prices proved false, the entire interlinked system froze. Banks stopped lending to each other because they couldn't trust the value of each other's assets. The credit flow that businesses and individuals depend on vanished overnight. This wasn't a stock market crash, it was a systemic cardiac arrest. How can an individual investor use this knowledge today? Look at the rise of passive investing and exchange-traded funds, ETFs. When you buy an ETF, you're buying a share of a fund that itself holds a basket of assets. The creation and redemption mechanism of ETFs is a brilliant piece of financial engineering that relies on a small group of authorized participants, large financial institutions, to keep the ETF's price in line with its underlying assets. Your ability to buy or sell an ETF at a fair price at any moment is a direct benefit of this hidden wholesale-level process. It's a modern marvel that makes diversification accessible, but it also concentrates power and potential systemic risk in a few key players. A quick story. Bring it back to a personal level with a mini-story. Maria, a teacher, automatically contributes to her 403(b) retirement plan every month. She never thinks about it. Yet her contributions are aggregated by a pension fund, which then allocates billions to venture capital firms. One of those firms funded a small tech company that later IPO'd, a company whose products Maria now uses every day. Her passive savings, funneled through multiple layers of the financial system, helped fund the very innovation that improves her life. Her financial footprint is far larger than her bank balance suggests. The critical takeaway is that the financial system is not a remote entity. It is a dynamic, sometimes fragile network of flows, and your money is a particle in that flow. Understanding whether your capital is being intermediated through a bank, a mutual fund, or a pension fund changes your perception of risk, return, and your own role in the economy. You are not a bystander. You are a participant. The system's stability and its crises are built upon the collective actions of millions, making financial literacy a personal and a social responsibility. Picture this: the blueprint for transforming your understanding into tangible action. Quick thought: track every dollar for 30 days without judgment, because awareness always precedes meaningful change. How many of us actually know where our financial energy goes? You'll likely discover patterns you never noticed, revealing both leaks and opportunities. Next, begin building your financial buffer, what I call your Sleep Well at Night fund. Aim for 3 months of essential living expenses set aside in a separate, accessible account before you even think about aggressive investing. This isn't about getting rich quick. It's about creating psychological safety in an unpredictable system. Remember that cash isn't just a number on a screen. It represents options, breathing room, and the ability to make clear-headed decisions when others panic. Big question: comes the crucial shift. Start viewing every financial decision through the lens of systems rather than isolated events. Are you paying down debt? You're not just reducing a balance. You're rewiring your relationship with leverage. Are you investing regularly? Here's a twist: you're not just buying assets, you're building a wealth-generating machine that works while you sleep. This mental reframe transforms mundane money tasks into strategic moves within the larger financial game. Finally, Commit to continuous financial education, but with a critical filter. For every hour you spend learning about hot investment trends, spend 2 understanding fundamental economic principles and behavioral psychology. The market rewards those who understand human nature more than those who merely follow charts. True financial literacy isn't about predicting the next big thing. It's about building resilient systems that withstand uncertainty and compound advantage over decades. Start small, think big. Build systems that outlast your enthusiasm. Think about it. You just spent the last half hour learning about a system most people willfully ignore. You now understand the invisible architecture of modern money better than 99% of the population. That's not just knowledge, it's a kind of quiet power. The kind that keeps you calm when headlines scream about inflation or a market crash. The financial world wants you to feel confused. It thrives on complexity. But you've just pulled back the curtain. You've seen the levers and pulleys. You know the magician's tricks. Big question, what do you do with that? Don't just be a passenger in this economy. You're no longer just riding the roller coaster. You're the one who's seen the blueprints and understands the safety mechanisms. You can see the cycles for what they are. This changes everything. The next time someone at a party starts confidently explaining quantitative easing, you'll have a choice. You can nod politely, or you can offer the gentle correction that the money being created isn't physical cash, but digital reserves that commercial banks use. The look on their face will be your reward. Remember, the goal was never to make you a central banker. It was to give you a lens. A new way of seeing the financial weather patterns so you can build a sturdier house for your own financial life. You are now armed. Go be boringly, confidently, and resiliently wealthy. The system is what it is, but you are no longer in the dark.